Hello friends, good evening to all of you, and today in this video we will be discussing the next part from the working capital finance and further related to the analysis of the financial statements. So kindly please do confirm the audio video quality so that we could proceed, and further if you're new to our channel, please do subscribe the channel, press the bell notification icon so that you get updated whenever we upload the new videos. The full course videos are available at our website iibf.info. Just do visit the website listed above, and further you can enroll the full course videos over there, and further you'll be getting the chapter wise previous year questions, mock test, and further the case study videos are also present over there. And also you'll be getting the complimentary access to the ePDF notes through our Android application. So do confirm the audio video quality so that we could proceed. And further, if you want to join us on our WhatsApp group, you need to WhatsApp us writing your name, mention CAIIB along with it, and WhatsApp it to the number 83609444207, and we will be adding you to the appropriate group over there. And further, if you want to join our Telegram group, the link is there in the description itself. You can join it over there. So confirm the audio video quality at the earliest so that we could proceed. So audio video quality over here seems to be working very fine. So let us start the session over here. So someone has asked over here related to what about the exam. So till date, there is no notification by the IIBF, but looking at the scenario and the different conditions under different states in India itself, it is possible. There are bright chances that the exam will be postponed, but you must be preparing with the same pace. Okay. So audio quality over here seems to be working fine. So let's start the session now. It's related to techniques used in analysis of the financial statements. So we do have three analysis methods by which we can analyze the financial statements over there. First of all, it is related to the fund flow statement. Then it is a trend analysis, and the third one, it is related to the ratio analysis. So first of all, it is related to the fund flow analysis. In fund flow analysis, let me tell you one thing. I already told you that liabilities are what? Liabilities are our sources of funds. If we just talk about the liabilities, these are the sources of the funds, and further the assets are uses of funds. Further, I told you that in liability itself, we were having the capital and the long-term liabilities. These are long-term sources of funds. These are basically capital and the long-term liabilities. These are long-term sources of funds. Like if some investor has basically invested the money into the company itself, that is for long term. Even if you have taken a term loan from the bank itself for a period of 10 years or 12 years, that's a long-term fund that you are having right now. Okay. So those are the sources of the fund. And similarly, if we look at the asset side, asset sides are associated with what? These are uses of funds. So if I say it is related to the fixed assets, where you have utilized the funds in creating a land building, or you have basically created the machinery out of it, so that is basically related to the fixed assets. And also there are non-current assets, current assets, which are created out of the funds using the sources. So assets are created out of the liabilities itself. Okay, so we can say assets are created out of the liabilities. So these are the uses of funds. So similarly, the fixed assets are basically related to what? These are related to the long-term uses. Whereas if we talk about the current assets, those are the short-term uses. Okay. And further, what it signifies over here, kindly please do concentrate, do focus on this particular point. It says if long-term uses means what? If the long-term uses, let me give an example that if we are having the land and building worth rupees 500, and these are the total fixed assets. So if we say the total fixed assets are given to be 500 over there, and further those are greater than the long-term sources, but the long-term sources were amounting 300 only. The long-term sources, actually what long-term sources comprise of? If we consider the capital and the long-term liabilities, these are basically long-term sources of funds. No, this is basically lesser than that of the assets so created, but I already told you that the assets are created out of liabilities. Now what is the possibility? The only possibility is that there is diversion of funds. That is, a firm has utilized its short-term sources so as to procure the long-term uses or long-term assets over there. Okay, so we can infer from the fund flow analysis like that. Okay, so that is how the fund flow analysis works. Okay, is that particular point clear over here? Let me explain to you this again. I just told you that the liabilities are the sources and the assets are the uses. And further, I told you that if long-term uses means we are having the long-term assets, that is a fixed assets, non-current assets. If those are greater than the long-term sources like capital, long-term liabilities like bank debt, bank term loan, etc. If those are basically greater than the long-term sources, what does it indicate? It indicates that the short-term liabilities, that the short-term sources have been used so as to basically procure the long-term assets over there. That is basically there is diversion of funds, because CC limit if sanctioned, that is basically sanctioned for day-to-day routine. Okay, that is not basically sanctioned so as for procuring the long-term assets. Are you getting this particular point? That is basically we can basically get an estimate from the fund flow analysis over there. After that, it is related to the trend analysis. Now, when we talk about the trend analysis, in that particular analysis, percentage changes are calculated for the successive years rather than the 2 years. So rather than basically considering 2 years, you basically do consider multiple number of years, and further you check the trend over there. So if we say that we are having we just take the base year to be 100%. For 2018, we considered the base year. As 2018 over here. And further, for 2019, our sales were, let us take the case that in 2018, our sales were 500. And we just took it as 100%. That is a base year. And in 2019, our sales are 1000. Now that will be 200%. Because we took 2018 as a base year. Now we will be comparing the different years. By way of changing the percentage over here. That is, we calculated over there. So we can look into the trend over there. So trend analysis is a long-term view. It's a long-term view, and it helps us so as to understand the trends are falling or rising. We have a falling trend or a rising trend, we can look into it. Okay, whether it is favorable or unfavorable. That is related to what? That is related to trend analysis. Then it is related to common size analysis. Common size analysis contains percentage of various figures. So whatsoever the important data that we require, we need to look into, that we need to scrutinize, we will be basically considering that particular data will be having a common size without corresponding to amount. We will be having a common size without considering any of the amounts over here. It helps us to compare between two periods or between the two different firms over there. So we will be basically looking to the common sizes over there. Common size statements make the analysis more meaningful, because we can compare the data in between the industries, in between the firm itself, between the two different years. So that is basically related to the trend analysis over there. And the third technique that we use for the financial statement analysis, that is the ratio analysis. So first one, it was related to the fund flow analysis. Second one, it is related to trend analysis, and the third one, it is related to the ratio analysis. Okay, so ratios are basically very much important, very much meaningful, and it gives us a very clear and transparent picture about different terminologies in the accounting statement itself. So what are actually ratios itself? If we talk about the percentage, if we talk about the proportions, if we talk about the decimal, that is basically those are representing the ratios over there. And in ratios, actually, we can compare, we can take the data from the different accounts over there, from different statements over there, and further can get an important data out of it, important information out of it, not data, important information out of it. Okay. Now let us have a look at the type of the ratios over there. So it can be in the form of the proportion, that is 1:2. It can be a pure number, or like 4 times, or a percentage, that is 150%. So these all represent what? These all represent the ratios. And how many ratios can be, the type of ratios are there? These are basically classified as liquidity ratios, solvency ratios, activity ratios, profitability ratio. Now liquidity ratio, as the name suggests over there, that it reflects the ability to meet the current dues. It basically reflects the ability to meet the current dues or the out of the short-term assets. So what short-term assets you are having, and further can you meet your obligations in the short term itself? That is basically the liquidity ratios related with. Second one, it is related to the solvency ratio. that it basically gives us a picture related to extent to up to the extent that the firm is dependent on the outside liabilities, dependent extent of the dependence on the outside liabilities, and the meeting up of the and the feasibility of the meeting up the if the need if arises of the if there is any obligation that arises in the near future, can we just meet up that obligation or not. So that is basically related to solvency ratio. And third one, it is related to activity ratio. Now what is activity actually? Are we using our resources, particularly are we utilizing them in an optimum way or not? Are we basically efficiently using them or not? These are related with those. And for the profitability ratio, basically related to the capacity of the unit to generate the profits and the rate of return over it. Okay, so these are the four ratios that we'll be learning related to. First type of ratio that we are basically going to cover, those are liquidity ratios, and it says current ratio. Current ratio is actually equal to what? It is equal to current assets divided by the current liabilities. Okay, so we are having the current assets on in the numerator, and in denominator we'll be having the current liabilities. Now current liabilities are those which are to be paid off, and current assets are those which are having, like if I am having the cash or stock in my hand, and further those are basically related to the amount that we have with us right now, and liabilities are those which are to be paid off, so if the ratio is lesser than 1, in that case the company has to borrow the amount, so as to pay its obligations, so as to fulfill its obligations over there. So this ratio particularly must be greater than, 1. What does it indicate? That the current assets must be greater than the current liabilities. The current assets must be greater than the current liabilities. Ideally it is actually given to be equal to 1.33 into 1. Ideally this ratio must be equal to 1.33 into 1. Okay, the next ratio that we are going to cover, it is a quick ratio, also said to be the SC test ratio. It is also said to be the SC test ratio. This is a stringent mode of the current ratio itself. So the current ratio basically it basically tells us, it relates with the liquidity position of the company itself, whereas quick ratio stringently it basically relates with the most of the liquid amount that is available, that in the current assets itself. I'm just quoting an example over here. So it says we are having multiple current assets like stocks, cash in hand, bank balances, prepaid expenses, debtors. Now these all do represent current assets, out of which will not be part of quick ratio over there, or the quick assets over there. Okay, so these all are the current assets, but out of which stocks are not quick assets. These are not quick assets. Other than that, prepaid expenses are not quick assets. Why these are not quick assets? Because these cannot be readily converted into the liquidity. That is why these are basically what? These are not quick assets. These are current assets, but these are not quick assets. Okay, so that is why quick ratio, or the SC test ratio, it's a stringent methodology related to the current ratio itself. Is that clear? So quick ratio is equal to what? It is equal to quick assets divided by the current liabilities, and further ideally this ratio must be 1:1. It must be 1:1. The next, it is related to the net working capital. Now what is net working capital? Net working capital is a difference between the current assets and the current liabilities. It is a difference between the current assets and the current liabilities. That is a net working capital. And for the working capital, actually what is working capital? When we just simply talk about the working capital, that is basically related to the total current assets. Working capital is actually the total amount of the assets that you are having with you, total amount of the current assets that you are having right now with you. That is basically the working capital. And what is net working capital? Because after paying off the current liabilities, whatever amount that you will be having, that is a net working capital. That is current assets minus current liabilities. Okay, and what is working capital gap? Working capital gap is equal to what? It is basically current assets minus current liabilities other than bank borrowings. Okay, so that is actually working capital gap over there. And for the financing by banks, is done on based on the working capital gap over there. It is actually the banks do finance based upon the working capital gap over there under the MPBF method, that is maximum permissible bank finance method. Okay, so there are three methods which were basically given by the Tandon committee over there. Two methods were accepted by the Reserve Bank of India and the third method was rejected. Okay, so under the Tandon committee methods, the working capital gap is a main factor. Based upon that, you basically decide that what amount will be sanctioned to the firm over there. Okay, so that is actually what, that is actually the working capital gap. So let me explain to you in very layman language over there that net working capital is the net amount that is available with the firm, and for the working capital gap is that particular amount which must be financed, either by way of the contribution by the firm itself or by way of the borrowings from the bank itself. The working capital gap over there, and that is the difference between the current assets minus the current liabilities other than the bank borrowings over there. Okay, so that is all related with what? Liquidity ratios. Next, it is the solvency ratio or the leverage ratios. Now, what is actually solvency ratio? I already told you, it actually basically indicates the dependence of the firm on the external sources. Okay, first of all, we will be covering the DER ratio. We will be covering the DER ratio, that is a debt equity ratio. Now, what is actually debt equity ratio? As the name suggests, debt divided by equity. Debt divided by equity. Equity basically indicates what? It basically indicates our own funds. If we just talk about a public limited company over here, if shareholders equity is basically representing what? It basically representing company's own fund. Okay, so if we are having 100 crores in our hand and further we have borrowed, whether it is by way of the commercial borrowing, whether we have borrowed the amount from the bank itself, that is basically the debt part now. So that would be basically, let us take the case that if we have borrowed rupees 125 and further we have our own funds equal to 100, and further that is related to firm A, that is related to firm ABC, and firm XYZ has borrowed rupees 500 from the market and has its own funds equal to 100. Okay, now in what case DER is more? Definitely in case of XYZ firm, DER is equal to 5, whereas in the case of the ABC firm, it is equal to 1.25. It is equal to 1.25. Now, which one is more riskier?